Hi friends, welcome back to the channel. I'm sure you've seen some TV commercials with Tom Selleck talking about all the benefits of a reverse mortgage to senior citizens.
I wouldn't be here if I thought reverse mortgages took advantage of any American senior.
I guess he's talking because people trust him. And I'm not saying that people shouldn't trust him. I'm just saying is that he talks all about the great things about a reverse mortgage, but he doesn't really tell you the whole story. So I'm here to tell you the story about what you have to think about and what you have to worry about when you're getting a reverse mortgage. So if you're 62 or older and want money to pay off your mortgage, supplement your income, or pay for healthcare expenses, you should consider a reverse mortgage. It allows you to convert part of the equity in your home into cash without having to sell your home or pay additional monthly bills. But take your time because a reverse mortgage can be complicated and it might not be right for you. A reverse mortgage can use up the entire equity in your home, which means at the end, you'll have fewer assets for you and your heirs. But if you do decide to look for one, review the different types of reverse mortgages and comparison shop before you decide on a particular company. So when you have a regular mortgage, you pay the lender every month to buy your home over time. But in a reverse mortgage, you get a loan in which the lender pays you every month. Reverse mortgages take part of the equity in your home and convert it into payments to you, a kind of advance payment on your home equity. So for example, if you have a $600,000 home equity and you decide to borrow $300,000, you can have that paid to you monthly. But what happens is the money you get is tax-free, and generally you don't have to pay back the money for as long as you live in your home. So when you die, sell your home, or move out, you or your spouse or your estate would repay the loan. But sometimes that means having to sell the home to get the money to repay the loan. Now, there are three kinds of reverse mortgages. Single-purpose reverse mortgages, which are offered by some state and local government agencies, as well as some nonprofits. Proprietary reverse mortgages, which are private loans and federally insured reverse mortgages, also known as home equity conversion mortgages. So if you get a reverse mortgage of any kind, you get a loan in which you borrow against the equity in your home. And instead of paying monthly mortgage payments, though you get an advance on part of your home equity, the money you get usually is not taxable and it generally won't affect your Social Security or your Medicare benefits. When your last surviving borrower dies, sells the home, or no longer lives in the home as your principal residence, the loan has to be repaid. And in certain situations, a non-borrowing spouse who's not on the loan may be able to remain in the house. So here are some really important things to consider. One is you owe more over time. As you get money through your reverse mortgage, interest is added into the balance you owe each month. That means the amount you owe grows as interest on your loan adds up over time. Number two, interest rates may change over time. Most reverse mortgages have variable rates, which are tied to a financial index and change with the market. Variable rate loans tend to give you more options on how you get your money through the reverse mortgage. Now, there are some reverse mortgages that offer fixed rates, but they tend to require you to take your loan as a lump sum at closing and not every month. And often the total amount you can borrow is less than you could with a variable rate loan. Okay, number three, interest is not tax deductible each year. So interest on a regular mortgage is tax deductible, but interest on reverse mortgages is not. You have to wait until the loan is paid off, either partially or in full. And number four, you have to pay other costs related to your home. Because in a reverse mortgage, you keep the title to your house. And that means you're responsible for your property taxes, your insurance, your utilities, any maintenance on the house, and any other expenses, because you still own the home. And if you don't pay your property taxes or keep homeowners insurance or maintain your home, the lender might require you to repay your loan right away. A financial assessment is required when you apply for a mortgage. So as a result, your lender may require what they call a set-aside amount to pay your taxes and insurance during the loan. It's sometimes called an escrow account. That escrow account reduces the amount of funds you can get in payments. Now, you're still responsible for maintaining your home. Remember, it's that important. So you might ask yourself, what happens to your spouse? Well, with a regular HECM loan, if you sign the loan paperwork and your spouse didn't, in certain situations, your spouse may continue to live in your home even after you die, if he or she pays taxes and insurance and continues to maintain the property. But your spouse will stop getting money from that loan since he or she wasn't part of the loan agreement. Now, what can you leave to your heirs at the end? Well, reverse mortgages can use up all of the equity in your house, which means you'll have fewer assets for you and your heirs. And most reverse mortgages have something called a non-recourse clause, which means that you or your estate can't owe more than the value of your home when the loan becomes due and the home is sold. So generally, if you or your heirs want to pay off the loan and keep the home rather than sell it, well, it wouldn't be possible. There are a lot of costs relating to a reverse mortgage. So how much does a reverse mortgage really cost? Well, like a traditional mortgage, there are costs associated with getting a reverse mortgage, specifically the home equity conversion mortgage, the HECM mortgage. Now, these costs are typically higher than those associated with traditional mortgages. So here are a few fees you can expect. The upfront mortgage insurance premium is paid to the FHA, a government organization, when you close your loan. Now, that protects you and the lender by making the loan a non-recourse loan. So if the home sells for less than what is due on the loan, this insurance covers the difference, so you won't end up underwater or with negative equity on your loan. It also protects you from losing your loan if your lender goes out of business or can no longer meet its obligations for whatever reason. In this case, the FHA takes over, so you can still access your loan proceeds. Now, the cost of this upfront fee is 2% of the appraised value of the home at a maximum of $726,535. Sounds like a mouthful. Well, that's the FHA's lending limit on a reverse mortgage. Now, interest rates. There are many factors that influence the interest rate for a reverse mortgage, including the lender you work with, the type of loan you get, and whether you get a fixed or adjustable rate mortgage. Most of these costs can be rolled into your loan, but you can pay any of them out of pocket if you want. So talk to your lender to get the most up-to-date costs, as fees may change. Now, if you're considering a reverse mortgage, I would shop around. Decide which type of reverse mortgage might be right for you, and that might depend on what you want to do with the money. Compare all the options, terms, and fees from all these lenders. Learn as much as you can about reverse mortgages before you talk to a counselor, and ask lots of questions to make sure a reverse mortgage could work for you and that you're getting the right kind of loan. It's really important that there is a lot of problems with reverse mortgages, because a lot of homeowners don't realize that, okay, they might be taking money every month, but at the end of the day, they lose all of their equity in the house. So, for example, they can run out of payments from the lender, have to sell the house, there's no equity in the house, therefore they get no proceeds from the sale of the house, and they're left holding the bag with no money or no way to get funds. They can't get it from the lender anymore, and they can't get it from the equity in the house. So these are really important things to consider. Now, it's not really that complicated, reverse mortgages. Just think of it this way. I'm going to have the bank pay me until I'm ready to sell the house. And if you like this video, please smash the like button. It really helps with the YouTube algorithm. I hope you enjoyed this, and until next time, thanks.